What's up, guys? John here. The first bank failure of 2024 occurred late last night, and people are trying to sweep this under the rug, trying to act like this is no big deal.
Republic First Bank was collapsed and was seized by state regulators. This is the first regional banking failure this year.
Republic Bank's assets and accounts are now being taken over by Fulton Bank, effective immediately.
This bank had $6 billion in assets, $4 billion in consumer deposits. Now, what if I were to tell you that this year, we're walking into a disaster in the U.S. banking system for a variety of reasons that Americans simply are, they're not being told the full story. Did you know March 26th of 2020, they put in a policy to where all banks throughout America do not have to have a single penny of your money in their banks. They can issue all the loans that they want, but they don't need to actually have the money. They don't need to have any of this money. And so what happened last year is they brought something forward after Silicon Valley Bank fell, First Republic fell, the disaster with Credit Suisse, PacWest got acquired by Bank of California. There was a lot of problems in the banking system, so they brought this bank term funding program out to help regional banks. And these banks, they borrowed $161 billion to try to keep the lights on. But they ended that program last month, March 11th. And this program, now all of these banks have to pay back all this money over the next 10 months, 10 and a half months. And the ones that don't are going to walk into a very, very significant problem. Now in this video, I'm going to break this down for you. I'm going to show you exactly what's going on in the U.S. banking system and why I believe we're walking into some serious problems here in America and why Americans need to get prepared for things to look a little bit bumpy, to say the very least, going forward. Please hit the like button. Hit the like button. YouTube will share the content, educate more people about what's really going on in America. And if you'd like to fix your credit, we would love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free call for Monday. Take a look at this. So the new low reserve tranche will be effective for all depository institutions beginning January 1, 2024. Effective March 26, 2020, the board reduced reserve requirement ratios on all net transaction accounts to 0%, eliminating reserve requirements for all depository institutions. Think about that, all depository institutions. Now this bank that failed yesterday, they had $6 billion in assets, according to Forbes, $4 billion in American deposits in January. Now, this situation is very, very fascinating because what a lot of people don't realize is this. The FDIC appointed a receiver, said Fulton Bank, a unit of Fulton Financial, will assume substantially all deposits and purchase all assets of Republic Bank to protect deposits. Now they hear the FDIC, they think, look, the FDIC is my friend. They'll bail me out. If things hit the fan, I have less than $250,000 in the bank. They're going to bail me out without question. I'm not worrying about it. Well, look at this. The FDIC, all they have is $121.8 billion. It might sound like a lot of money, right? It might sound like a lot of money, but all American deposits, total deposits, are $17.4 trillion. So they have $121.8 billion to secure $17.4 trillion. Now I know a lot of people are going to say, John, there's a lot of people that have way more than $250,000 in the bank. The reality is only 0.83% of deposits are over $250,000. So if you look at this 17 trillion, let's just say 10 trillion, 8 trillion are not, above the 250,000. How many people are actually going to get paid out on this FDIC? I would bet a very small percentage. And I would probably bet that Sally the hairdresser, Mike the plumber, Joe the nurse, or, Sally the doctor, they're not getting their money, right? If things really hit the fan here. I would bet that it's going to be the people that are, plugged in that are going to get paid out. And everybody else, as history shows us, are going to get stiffed. So this situation, this bank term funding program, March 11th, this allowed banks to deposit or to borrow $161.5 billion. And now they have to pay this money back. They have a one-year loan, so it expired March 11th. So, you think about this. A lot of people didn't take out their loan March 11th or March 10th, the day before it was expiring. They took it out last year when things were tough. Over the next 3 to 6 to 12 or to 9, 10 months, all of these banks should have to start paying back this loan in a balloon payment. How many banks are going to be able to do that? It's the real question. I'm betting not as many as people would like to think. And a Fed tool that buoyed U.S. banks put reserves in a spotlight. Now, when you look at what happened yesterday, they said the inflation report came out showing inflation is very, very high. And why this matters for banks is because it looks like interest rates are going to stay higher for longer, and that's going to put more pressure on banks because banks tend to invest in bonds and other securities which lose value when interest rates rise. So they've invested in bonds, securities, and commercial real estate, all of which are performing horribly. And at the same time, U.S. consumers pulled out $872 billion in deposits year over year. You think about that. Why? The cost of living is absolutely crazy. Everything is extremely expensive. Many Americans don't have the leisure of saving. They have to spend their money. And so this is another big headwind for banks. I mean, look at this. Majority of large U.S. banks posted declines in their deposit balances year over year, with almost 30% of $871.6 billion industry-wide decline attributable to the big four banks: J.P. Morgan Chase, Bank of America, Wells Fargo, and Citigroup. Now, this scenario that's unfolding here, investors price in growing chance of another Fed interest rate rise, is going to put people into a different place financially and mentally. They're looking at everything on the the writing on the wall. Even Jerome Powell is saying Powell warns commercial real estate woes will lead to bank failures. This is a problem that we'll be working on for years. Now look, they're not working on this. They know it's coming. They know it's coming because it's the biggest rug pull ever for the U.S. banks. I mean, think about this. They put interest rates at basically zero the last few years. They told banks to lend out as much money as possible. Don't worry, you don't have to have any money in the bank. You don't have to have any reserves. And banks were investing their money. And then they just started hiking every meeting, hike. And they're continuing to keep rates higher for longer. You don't think that they know that banks are going to end up failing because of this? Of course. A 2-year-old could tell you banks would fail in this situation, right? And this is the scenario that's now being worked through the U.S. economy, and it's being told as though, look, we had no idea this is coming. Please give me a break, right? Look at this. In this, it's shocking. This is what banks are going through. And by the way, if you look at this, and look at this right here, these banks account for 80% of total loans. So regional banks are issuing loans on 80% of all commercial real estate. 80%. And so look at this. 5 hours ago, just in, Blackstone sells New York office building at a shocking $420 million haircut. It sold for $181 million. They bought it for $605 million. Look at this. Just in, an office complex in Illinois sells at an 88% discount. $7.9 million for this building, right? Like, who's holding all this debt? Regional banks. $7.9 million. You're looking at like a $56 million loss. You think that the investor just happened to have all that cash and all that equity in the property? No, if they did, they would just hold on to it. The banks forced the sale because on these deals, the commercial real estate, it's not like a 30-year fixed rate mortgage. Every 3, 5, 7 years, they have to go back to the bank, and the bank's going to look at the cash coming in, the expenses, and make a determination on if they want to issue another loan. And a lot of these banks owe a lot more than the property's worth. They're not issuing these loans. Look at this one. 90% discount in San Francisco. This building sold for $6.5 million. How shocking is that? $6.5 million this building in San Francisco. All these different buildings, just in, building in Chicago sold for $2.5 million, $14 a square foot, 90% discount. This is all, this is devastation for regional banks. And these banks, the sad reality is that a lot of regional banks are the ones that issue all the funding to Americans. And if these banks are going down, with it goes small business. Where do people go when they want to get a small business loan? They're going to the local regional bank, their credit union. They're not going to J.P. Morgan Chase, not going to Wells Fargo in most cases. And so when you look at this scenario, this is all setting up these big banks to become massive institutions over the next couple of years as these small banks begin to fail. And it's just one major loss after the next. It's crazy. Look at this, another 60% discount. This deal is priced at $115 million. And they paid $270 million 9 years ago, right? And so here's how bad this situation is right now. The commercial real estate debt market is poised for a record-breaking event the year. $929 billion in loans are set to mature, with an additional $1 trillion anticipated to come due over the next, call it a year and a half, 2 years. Right? Maturities represent 42% of the sector's outstanding debt. So 42% of the sector's outstanding debt has to mature over the next 2 years. Think about how much damage this is going to wreak through regional banks. Now, when the entire commercial real estate sector, and by the way, commercial real estate is not just office towers like this. Commercial real estate's 5 apartment units or more. It could be an industrial property. It could be in a hotel. It could be, a large apartment complex. Like all of these assets are considered commercial real estate. And when you have 42% of this debt that is rolling over in the next 2 years, 80% of which is held by regional banks, as these regionals start to fall, people are going to start pulling their money out of these banks quickly, and they're going to likely, and unfortunately, put their money with the big banks like JP Chase, thinking that they're too big to fail, all of which is going to allow JP Chase to get bigger, right? And so this entire situation is, I think, what led last year to where we had 60,000 jobs being cut from local banks. Just last year, right? Yet JP Chase is opening 500 new locations. They're hiring a lot of new employees, renovating 1,500 branches. They're getting ready for it. Top real estate CEO warns 500 more banks will either fail or be consolidated over the next 2 years. Now, this came out last month. About a month later, or a month and a half later, we already have our first failure. So it's getting positioned for this as everything is just perfectly primed for a disaster for regional banks. And it's an unfortunate reality, but it's a reality that they all knew was coming. Janet Yellen said that this is coming. I mean, there's even a meeting where they were talking about bank runs. The Fed, they know that if you look at Silicon Valley Bank with the power of social media, the moment something happens, it's like a fire in a movie theater. Everyone's rushing to get out. And with how fast information moves today, it doesn't take much. It doesn't take much for this thing to really, get out of control. What do you think about this entire situation? Do you think that this bank failure that happened yesterday is going to be the start to it? What do you think about this $161.5 billion that has to get paid back in the next 10 months? They're saying right here that our assumption is that the new borrowing will essentially fall to zero. So if they can't borrow money at a reasonable interest rate, one in which makes sense for that bank, as they see their deposits getting pulled out and their losses growing dramatically across securities and bonds and commercial real estate, people aren't paying back their personal loans or auto loans, or delinquencies are at all-time highs, all of which is just horrible for regional banks. How do they see the end of this inside of this interest rate environment, inside of this economy? Let's have a conversation below. Curious about your opinion. And if you'd like to fix your credit to position yourself what I believe is going to be a tighter lending environment, and I believe in an environment that's going to offer a lot of opportunity, because as it gets harder to get access to capital and liquidity, those that have access to money make the rules. It's always been that way. So if you'd like to fix your credit to position yourself for funding, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free call for Monday, and I'll catch you next video.